The BCG Growth Share Matrix is a strategic tool that helps companies decide how to manage their different businesses or products within a portfolio. It does this by evaluating each item based on two key factors: relative market share, which is shown on the horizontal axis, and market growth rate, shown on the vertical axis. By looking at these, the matrix divides products into four groups: stars, which have high market share and high growth; cash cows, which have high market share but low growth; question marks, which have low market share but high growth potential; and dogs, which have low market share and low growth. This framework makes it easier for companies to prioritize where to invest, develop, or potentially phase out products based on their market position and growth prospects. The BCG matrix is a useful tool because it helps prioritize where to put resources, showing clearly which parts of the business to invest in for growth and which to consider for divestment. It gives a visual snapshot of how healthy your portfolio is and guides future strategy. The matrix divides products or business units into four quadrants based on market growth and share. Stars are products with high growth and high market share that need ongoing investment to maintain leadership and will eventually turn into cash cows as their markets mature, like Apple's iPhone in the fast-growing smartphone market. Cash cows have a high market share but low growth, generating steady cash with little reinvestment, which helps fund stars and question marks. A classic example is Microsoft's Windows OS in a mature PC market. Question marks are in high-growth markets but hold a low market share, so they require resources to grow, and the choice is to invest heavily or divest. Google's cloud services illustrate this category, competing with big players like AWS and Azure. Dogs have low growth and low share, often candidates for divestment or phase-out unless they have a niche profitability or synergy, like Netflix's DVD rental service, which is becoming less relevant as streaming dominates. To use the matrix effectively, first map your portfolio by plotting each unit based on their market share and growth using current data. Next, analyze each quadrant, keep investing in stars, harvest profits from cash cows and optimize efficiency, carefully evaluate if question marks should grow or be divested, and consider divesting or repositioning dogs. Finally, allocate resources by channeling profits from cash cows into stars and promising question marks while avoiding overinvestment in dogs. It's important to review the BCG matrix regularly because markets and business units evolve. Stars can turn into cash cows over time, so reassessing helps keep strategies relevant. Many major companies use this tool in practice. Amazon views AWS as a star, its marketplace as a cash cow, and Prime as a question mark. Google categorizes search as a star and ads as a cash cow, with YouTube Rising and cloud considered a question mark. Samsung applies the matrix across diverse sectors like smartphones and home appliances. The matrix offers a clear, simple visual guide for strategic planning, helping companies decide where to invest or divest. However, it depends on accurate data and doesn't capture all aspects like synergies or market lifecycle complexities, so its categories can sometimes oversimplify. To get the best use out of it, pair the matrix with other tools like PESTLE, SWOT, or discounted cash flow analysis. Apply it at the right scale, whether business units or product lines, and update it regularly to reflect changes inside and outside the company. Incorporating the BCG Growth Share Matrix into planning thus gives businesses a structured way to allocate resources, manage risk, and focus on growth opportunities while sustaining mature revenue streams, helping maintain a competitive edge in changing markets.